Okay, welcome to my order flows presentation. This one is called 60 Minutes Order Flow Trading Tutorial. First, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. So the main question you are probably wondering is why trade with order flow? What makes it so special? Well, order flow allows you to trade the market based on what's happening now as it happens with your own decisions and not dependent on some indicator trying to tell you what happened based on the past. One of the benefits of, I don't say benefits, but one of the main features of order flow is you're seeing orders coming into the market, trading, getting filled, people's commitments, whether they're getting long, getting short, they're stuck in a trade, what have you. That's very valuable information that you can use for your trading. So, just real quick, just sort of what I'm going to talk about today is why trade with order flow. Who am I? My story. The benefits of order flow trading, how order flow can improve your trading results. And at the end of the webinar, I'm going to give you a link where you can download my top 3 order flow trade setups. So who am I? Well, my name is Michael Valtos. I spent 8 years trading at JP Morgan, 4 years at Cargill, 3 years at Commerce Bank, 2 years at EDF Man. I started my career as a runner on the CME floor with Dean Witter. Back in those days when you had the trading floor, that was the, I'll say the easiest way, but that was the best way to get exposure to the market fast. Nowadays, if you want to, become a trader, I think the path is a lot harder. You have to go to school. I graduated college, but still, I have a lot of friends that went down to the floor, and they went to the floor after graduating high school. They were supposed to start college in the fall, but after a couple months on the floor, they realized this is their calling, and they never went to college. They became very successful traders. Nowadays it's changed. You don't have a floor in that sense. You have training firms, but these firms to get a job at, you have to have a degree in advanced math. You have to literally be a rocket scientist at some places. That's not to say that and a blue collar person can all of a sudden say, hey, I want to start trading, and and figure it out. They can. The barriers to entry are lower in the sense that you can open a trading account at a firm like whatever, Ninja Trader Brokerage, AMP Futures. You can start with a few $1,000s and sort of get your feet wet and learn how to trade. I think you should have a methodology to trading, and order flows is that methodology. So order flow is a term that has been tossed around the last few years as a new way of trading, but order flow has been around for decades. I want to say centuries, but it's been around for at least 100 years. Back in the old days, people used to read the ticker tape, to see the prices coming through, and base their decisions off of that. And even when there was a pit, obviously the people in the pit were reading the order flow. They would look at what was happening, the orders coming from the big brokers, the Lehman Brothers, the Goldman Sachs, JP Morgan, whoever. They were watching the flows coming from the desk, especially when the market's slow. Goldman Sachs broker starts flashing to the pit, hey, what's in there? And everyone's going to turn and watch to see what's what types of orders are coming in. Even the big traders, right? They, the Paul Tudor Jones, right? He had his guy in the treasuries, the unit guy, I believe they used to call him, because Tudor Jones would trade in a certain size, and people would watch, see what direction he's going. It's that was order flow back in 20, 30 years ago when there was still a floor. Now times have changed. It's all electronic, and the information's still there. You just have to learn how to read the information. But like I said, order flow provides traders with the best real-time view of what's happening in the market as it happens. Like I said, when you're seeing actual trades come in. Now, I just want to preface it by saying, there's probably different types of order flow. There's people trading off a dome and seeing, orders going in the order book, 2 or 3 price levels away. And then there's order flow trading off a footprint chart, which is actual trades being traded, is actual volume, being added to the daily volume. It's actual trades occurring. That's what a footprint chart gives you. Now, a lot of the order flows trader software is a footprint chart. So, what this talk today will be about is about a footprint chart. It's not off a dome trading. There's dome trading is, on the surface it looks great. You think, hey, this is great, I could do this. But really the amount of dome traders that are successful is quite small. I mean, any type of traders are quite, successful traders. The group is actually quite small. So I mean, don't think that you can come into it without much experience and pick it up. Yeah, some people can, just like some people can pick up a basketball and all of a sudden start shooting free throws like they've been doing it their whole life. It's like that in trading. For some people, some things just click, and for other people, it just doesn't. So once you understand what's happening in the present, you're able to make better decisions about what can happen in the future. So, again, what I'm talking about with order flows, you're reading the flow of trades that are occurring in the market to make your trading decisions. Based off of, what's happening now. If you're trading with, indicators, Bollinger Bands, MACD, RSI, things like that, it's just basically a mathematical derivation of price. You should be looking at what's happening to price right now and the volumes that are trading in there to make your decisions. You don't want to necessarily know what happened, 50 time periods ago. Do you really think that what happened, 20, 25 time periods ago is going to have an effect on what's happening right now? Most likely not. What you want to see is who's being aggressive. Is supply and demand changing? Is the market going from a supply-driven market to a demand-driven market? Or, are prices being rejected? These are questions that you should be asking yourself, all day long. If you're just following an indicator blindly, it's not really telling you much of anything that's happening now. It's showing you things that happened in the past. So, buying an indicator or trading system won't help you to learn how to become a profitable trader. I'm sure, most traders, most independent traders, retail traders, have gone down that path. They bought an indicator thinking, this is it. This is what's going to turn the market into an ATM machine for me. It's not like that. You buy an indicator, you don't necessarily know, what's the logic behind it. If, oftentimes you buy an indicator and, you feel something's missing. It's, a trader or teacher that can talk to you to help you understand and learn the trading method. Nothing is worse than buying a indicator and not understanding it. It's, you're paying your money for something. Don't you sort of want to know how it works because you're putting your money on the line. It's not like you're buying a new hand phone, the new Samsung. You don't need to know how it works inside. You just want to make sure it works. But, you're not making putting money on the line every single day with it. You know, when you're trading, you should learn how to trade rather than take trades. You know, nothing. Yeah, I mean, and part of the problem that I'll say I have, but you know, part of the problem that people have in the markets today is they buy something and you know, there's no real explanation, there's no education, you know, on understanding the basis for it. You know, it's valuable to have someone you can speak to or ask questions to, you know, about the market, you know, why it's happening, well, why something is happening, you know, and what you're seeing in the market. You know, when you see just an arrow based off of an indicator, you know, appearing on your chart to sell, well, how do you know it's valid? You know, how do you know the system is working properly? You know, you don't. You just see, oh, there's an arrow, I should sell. You know, you're like those rats in the cage. You know, they know that if they press the thing, they'll get something to eat. It's you know, it's not trading. You know, if you're serious about the market, you want to be a trader. You know, you have to learn how the market operates. You have to learn how to trade. You know, and order flow is in my opinion probably the best way to learn how to trade, because you'll learn how supply and demand affects the market. You'll see why, you know, the market trades down to a certain level and then rallies back up. You know, often if you know, imagine you're like Jack and Jack in the Beanstalk, and some guy comes up to you and says, "Hey, I got a system here that can teach you how to tell where the support or resistance is in the next bar based on the bar, you know, what's trading right now." You know, would that be important to you? You may think, you're a crackpot, you know, get lost. But you know, I mean, if it, you know, you can, you know, there's with the order flow, you can see where support is going to be in the next bar, you know, or resistance is going to be in the next bar. And, you know, you're going to see areas of support and resistance that are areas that are generated by the market generated information on what's happening in the market. So, you know, that's the real power of order flow. All right, so, you know, let's just jump right into it. Here's a chart of the E-minis. This is a 5-minute chart. This is on April 4th, 2016. So it's just a couple earlier this week. And, you know, up in here, you have the market trading basically around 62.5 and 64. You know, before selling off down to, you know, 55, 55.5, 56. Comes back up, comes back down to 55. You know, this is a nice move here from 63 down to 56. You know, it's a 7-point move. That's a nice move. You know, wouldn't you like to catch that? You know, catch one of those once a day, and you know, you got money in both ends, saying yippee yippee. So, you know, looking at a normal bar chart, is there any reason to get short? Yeah, some candlestick guys will say, oh, you're supposed to do this because it's that. Or, you know, say you're trading a moving average, it breaks down somewhere in here. You know, wouldn't you rather have a reason to be getting short, you know, somewhere up, you know, based on what you're seeing, you know, right up here, you know, and catching the whole move? You know, if you got a moving average, it's kind of lagging in here. It's not going to tell you to be getting short right here. You know, the average, you know, I don't have what happened just before this. If I remember right, it was kind of trading sideways. So, you know, if you could catch a move like this nice 7-point move, then, you know, those are the type of moves that you want to catch. Right? You don't want to necessarily be looking for, you know, this is 7 points, right? Not 7 ticks. You know, a lot of traders, you know, I see people talking about how they got, you know, 3 or 4 ticks out of it, you know, out of a move. I mean, come on, 3 or 4 ticks isn't, you know, you'd have to do that, you know, 10, 20, 30 times a day to make money. Wouldn't you rather be more of a cerebral trader and, you know, catch 5, 6, 7 points out of the market? So, you know, is there any sign in there? No, I don't see any sign. I mean, if you're looking at a normal bar chart, again, I don't necessarily see any sign to be getting short, to be getting long. You know, I don't necessarily see either one in there. On an order flows chart, you know, I see something completely different. I see price rejection up here. I won't get into the ratios in this chat today, but there's a ratio up here telling me that price is being rejected. All right, so you have this price rejection up here. That's your sign. In the order flow, it's telling you price is being rejected, and to be getting short. Right ahead of the market selling off. You have another sign in here, a stack selling imbalance, where you got aggressive sellers coming into the market, and sort of to hold the line and stay short into this move. So again, you're getting your sign up in here when you're trading, up at 63 to be getting short, to help you catch that move down to 56. Now, this is again, this is a volume footprint chart, and it's telling you different things. This is the volume that's traded on the bid. This is the volume that's traded on the offer. The market's always bid and offered, so you're always going to have a number 549 against 41, 322 against 509. You're going to have some numbers that are black, you have numbers that are red, and numbers that are blue. If they're black, that's just the normal volume. If you see a red number or a blue number in the bar, it's telling you that you have an imbalance, that sellers were buying or selling more, buying into the bid at a ratio of 4 to 1, 400% more than what was traded against the offer. So, 41 against 549, 66 against 1086. The ratio here is, 66 against 1086. It's 400%. It's over 400% more. 322 against 509. The ratio is not above 400%. Now, there's going to be times where you have multiple imbalances in the same direction where they're stacked on each other. You call that a stack selling imbalance. And, it's just basically telling you that there was some really strong selling going on at this point right here. And, the order flow software, which I get more into, you can read about it on the website or watch some of my other videos, will indicate to you where areas where buying or selling is drying up, potential areas that you can be looking to get long or get short. Okay, now this is, again, it's another 5-minute chart, and just going back to my, to that Jack and the Beanstalk example, what if, you came into this low down here, at 2037, and you start to rally up. Now, at some point, this is going to be your support, but as you're going higher and higher, what if you can sort of find an area where that there's going to be support, where the market will come back down to test it and go back up, come back down, test it like you're doing here. Why is this level here so important? You came down to it once, came down to it twice, came down to it a third time, a fourth time. Each time you come back into that area, you pop back up another 3 points, 2 points, 40, this level is 43, 45, you came back up twice. In 2 cases, you got up to 46. It's a 2-point move, it's a 3-point move. What's so special about this area? Well, people say, well, you look back here, you have this, these areas here. Well, what's so special? This is where the bar opened. This bar opened here, closed here. This bar opened here and closed down here. That's nothing. It's not any sort of recent high because, your highs are up here. What's so special about this area? Well, if you're looking at the order flow, you can see you have a stacked buying imbalance. You got 1, 2, 3, 4 levels of aggressive buying. Where the ratio, 66 against 424, 23 against 436, 61 against 471, 26 against 844. Those are aggressive buyers. Even in this earlier stacked imbalance here, the market in the next bar came right back down, tested the low, went back up. Here we opened up here, went much higher, came back, sort of held it. We did close a little bit. This bar is a red candle, so it closed a little bit lower. but the next bar opened outside of it and went lower. But oftentimes what you're seeing is, in the immediate term is, it's a support level. What if, like I said, what if someone said, hey, I could help you find a support and resistance level for, the next few bars based on what's happening right now. Would you find that valuable? I find it extremely valuable. I have this buying imbalance right here. This next bar never even comes back down to it. You have another stacked buying imbalance here, and it's held, for how many, this is a 5-minute chart, so you're looking 5, 10, 15, 20, 25, 30 minutes. Every time it comes back in there, it pops back up. Just like you have it here, it opened up inside that area, and it held and it went higher. You're talking, from 42 up to 46, 45. So, that's a nice little move. Now, I don't look for these levels to be holding all day long. My software, my Orderflows trader software will draw it out five bar levels, the next 5 bar levels, the next bar levels, the next 5 intervals. So whether you're using a minute chart or a 5-minute chart, it'll go the next 5. If you're using a range chart, it would also be 5. You can adjust it in the settings of the software, however you want it. Say you just want to look at it for the next 2 or 3 bars, you can. If you don't even want to look at it, you can turn it off, and it's up to you. Okay, retail traders try to use classic technical analysis, but in most cases, they're simply using technical indicators. Classic technical analysis is basically different manipulations of changes in price, for example, MACD, RSI, Bollinger Bands, moving averages, etc. I don't know if that's the right way to put it. Classical technical analysis can also include trend lines and head and shoulders patterns, sort of chart formations. But nowadays when people talk about classic technical analysis, I think people don't necessarily do as much research into it. Back in I said back in the days before the home computer, and people had chart books that they would look at. So people would draw chart patterns. Now you have a computer. It's not necessarily as easy to draw chart patterns, but what people do now is they just mathematically manipulate price. That's where you have all these indicators: MACD, RSI, bands, averages, etc. Now, the difference between retail traders and institutional traders is, how they make their trading decisions. Institutional traders make decisions based on macro views of the world, and how events are happening, is going to affect the price of a commodity or of a market. They don't sit there and say, oh, MACD crossed the 0 line or something like that. They don't sit around in their office staring at indicators. Now, some people would like you to believe that that's what happens, but they don't. These guys take views on the market, and they are willing to back it up with money. They're not in and out in 30 seconds flat. They have long-term views, and like I said, they're views on what's happening in the world. Now don't get me wrong, there are some hedge funds out there that are purely Renaissance technologies. They're a big, I hate to call it a HFT fund, but they do a lot of mathematical analysis on things. To get a job there, you literally have to have a PhD. You got to be a rocket scientist. Literally, you have to be a rocket scientist, I think, to get a job there. Now, that's all well and good, for them. But most people, most traders, aren't rocket scientists. I think that's why people sort of gravitate towards indicators, is because they're looking for something to tell them what to do, rather than understanding what's going on in the world. That's why that's the difference between institutional traders and retail traders. Institutional traders understand what's happening and can interpret it into the market to make their trading decisions. Now, getting back again to difference between retail traders and institutional traders. Retail traders follow price and they think all prices are equal. Retail traders will spend their day watching price on the screen. You have to realize that not all prices are equal. Each price has its own unique character. You get to a level in the market where, yeah, it trades there. It may trade, 1 lot, 3 lots, 5 lots. That's not the same as when it trades 1,000 lots. If it trades a small amount, it's important to know why, or that it traded a small amount. Or if it traded, a massive amount, it's also important to know that it traded a massive amount. And, how did the market react in both cases? So, here, just real quick, this is an order flow chart, and you're seeing, areas, you come up here, you hit a high, and the market's coming off. You got, again, I won't get into the ratios, but, you have a ratio up here indicating that price is being rejected. Market sold off. It came right back up here. Another sign that price is being rejected. And then it started to sell off, and you got a stack selling imbalance. So to think that all prices are equal, if you're using an indicator, most of the time they're just looking at price and saying, okay, it printed there, this price up here has as much importance as this price down here, or this price in here has got as much importance as this next price. It's not always the case. That's not how. If you take all prices as being equal, then I think you're assuming too much and reading too much into the market. You have to understand that all prices are different. For example, you go to do your grocery shopping, and say you want to buy a steak, right? And you go to one store, they have it on sale. Well, would you rather buy it, from the same, okay, I won't use steaks, but say you want to buy milk, right? And they're all coming from the same dairy, Golden Dairy. And, one store has it for $2.99. The other store has it for, $3.25. Now, you might think, well, okay, I should just buy it where it's $2.99. Yeah, you should. And, the market's the same way. There's still going to be people buying it at $3.25 just because they're in the grocery store and they need milk. It may be closer to them. For whatever reason, there are people sometimes they're still going to buy it. Does it make it worth any, is the extra 26 cents worth it? No, it's the exact same thing. So if you can buy that milk at a cheaper price, you're buying it at below the value. It should really be selling for $3.25. So, imagine it in market context, $3.25, we'll call this price up here $3.25. There's going to be people that buy it up here. There might not be as much people, but if you can buy it down here at $2.99, $3, you're getting a good deal on it. You're getting, something that's, it's cheaper. Now, there's going to be the people that buy it up here, but, there's just going to be a couple people. Here you got 9 people bought it at this high level, then the market sold off, so, maybe the grocery store realized, hey, we can't sell it up at $3.25. We got to lower our price down, down to get down to $2.99 where everybody else is trading it, is buying it at. So, order flow exists in everyday context. Sometimes people just don't realize it. But it's out there. If you keep your eyes open, you'll notice it. Okay, so you have to understand the market in terms of the behavior of the people who you're competing against. The behavioral thing to understand in the market is who is doing the buying and who is doing the selling. Now, getting back to, not all prices are equal. Well, every time you have a transaction in the market, right, you have a buyer and you have a seller. Now, that's obviously, it has to happen, but you can have different types of buyers, different types of sellers. You're going to have people that are aggressive, and, what is an aggressive buyer? Okay, just getting back to our case of the everyday example of order flow trading. Say you go in to buy a car, right? And you have your idea. Say you want to buy the new Corvette. You have your idea in your mind what you want to pay. The dealer has in his mind what he wants to sell it at. Now, you want to buy it at your price. He wants to sell it at his price. Eventually you guys are going to go back and forth until one of you is going to get aggressive. Either the dealer is going to sell it at your price, sell it to you at your price, or you're going to have to pay the price the dealer wants. Whoever that is, whoever that person is, that's the aggressive buyer or the aggressive seller. Now on the order flow chart, again, it will show up, that's what these, you have your bid, you have your offer. And, so whoever buys, on the bid, they're considered passive. Whoever sells into the bid is the aggressor. And whoever, say if someone's selling, whoever's on the offer is passive. It's the person that trades into the offer, that buys the offer, is being aggressive. Now, when you have an imbalance like this, 72 against 0, you have a case where, you have a ratio of over 400% of more sellers, than what's being traded on the offer. So like in this case, 9 against 2 it's not over 400%. But, 72 against 0 obviously is 203 against 74 is not. 383 against 54 is. So it's telling you that, the aggressive sellers are, are taking control of the market. You're seeing more aggressive selling. You're seeing more selling imbalances. Is this usually a sign of aggressive selling? Just as if you see, buying imbalances, it's a sign generally of more aggressive buying, because people are coming in and they're wanting to buy, lift the offer, buy it at the market. As everybody wants to get in as the market's going up. As the market starts to come down, you tend to see more aggressive selling. So again, order flow has to be understood and applied in terms of market context. If you're looking for a reversal in the form of a price rejection, you have to have a trend or a move to reverse. So, again, when I say you have to understand it and apply it in terms of market context, if the market's not going anywhere, if you're trading sideways and you're getting signals, it's not going to be as, as strong a sign than if the market is, you're getting a sign that selling is, or that buying has dried up near a high. Well, it's a much more stronger sign when you're getting a price rejection at the end of a move than sort of in the middle of the move. Like I said, if you're looking for a sign that the market's going to reverse, well, it's much better after the market's already made a move rather than the market just been trading sideways. So, Orderflows Trader, which is the software I developed, it's a footprint chart, but I've added a lot of things to it to help a trader understand and read the order flow. I mean, because just looking at an order flow chart, a volume footprint chart by itself is kind of intimidating. You see a lot of numbers. You think, oh my gosh, I hated math in school. You don't need to know math or anything like that, but still, you see a lot of numbers, and it is confusing, but it's actually not. It takes a lot of information and synthesizes it into a form that's very easy and very simple to read. I think the information that you get will help you make better trading decisions. And, the problem for a lot of people is information overload, analysis paralysis, too much information. Sometimes they think if they have more information, they can make a better decision. Well, yeah, in theory, that does make sense. Let's say you're buying a car, right? You want to get as much information about the car as possible. But, at the same time, you're getting so much information, you can't make a decision. And by the time you make a decision, it's too late. So, Orderflows Trader, my software, is one that, takes the information and just makes it easier to read and understand. Like I said, you see a lot of numbers, and if you don't know what you're looking at, is that if you're not, I've been trading in the markets for 20 years, so I'm in tune to what I want to see. But a lot of people have come to me and said, "Hey, teach me how to trade." Well, it's not as easy as one, two, three. So that's one of the reasons why I'll say I had to create the software. One of the reasons why I wanted to create the software is, I help people to learn how to trade, but at the same time, I've got a lot of experience, and most people generally don't. So they come to me sort of with a clean slate, and I wanted to help, sort of build the foundation, and I put some of, I say some, I put most of the ways that I think about the market and look at the market into the order flows trader so that, they can see what's happening in the market and, make the decision, if they want to take a trade or not. So it's, again, it's something that will, as a trader, order flows can really help develop you, and, become a profitable trader. Now, again, a lot of people think that, wow, when you're reading the order book, or, reading a dome, or reading a footprint chart, or any type of chart, people always want action. They always need to be in everything. Now, I feel that with order flow, and especially with my order flow trader software, it allows you to take a step back and sort of look at the market as to what's happening. Imagine, when you go up to the top of a tall building, they have a viewing deck. You can look out, you see all the people walking around. You can see the traffic down there. Sometimes you can see cars coming into intersections, you see an accident happen. Imagine, that's like with order flow. You can get this view of the market as to, people, levels that they're buying and selling at. Are people being aggressive or not? Or is just, the market just doing what it's supposed to do? Is it just transacting, trade? The markets exist to facilitate trade back and forth, and that's what it does most of the time. However, there's going to be these times, these periods, either on edges or extremes, or in swing highs, swing lows, where you're going to get a change in supply and demand, and that's what looking at order flow will alert you on when it's happened. So you could get in on the move, as it's just after it's happened, or if you're eager, just as it's happening. Now, again, not every single print needs to be analyzed. I mean, I look at charts. I look at different markets during the course of the trading day, and I've got 4 or 5 charts on my trading screens, 4 or 5 different markets. I don't sit there and analyze every print that goes through the market. Say if you're watching a dome, you get eager. You see a lot of prints go through in a burst. Think, oh my gosh, I should be trading. It's order flow sort of allows you to take the step back and just I said, get a better view of the market as to what's happening. Okay, so real quick, I'm going to go over a few charts and just give you examples of of how to read order flow charts. Now, again, this is a E-mini, a 5-range chart, and it's a footprint chart. So you're seeing price levels, bids and offers being traded. You're seeing price levels where there's a bid. What's traded on the bid side, what's traded on the offer side. But how you read an order flow chart, and how you should read it, is what traded at the price level below against what traded against the price level on the high, just slightly above it. So 423 against 430, because the market's going to be 2058 bid at 2058 and a quarter offer. That's how it's going to trade. It doesn't all trade at one price. So to analyze, 423 against 416 is not how you should be approaching it. You should be looking at it because the market trades, it's bid offered, bid offered, bid offered. And the market's going to move in that direction. It's going to, people are going to be buying the offer, they're going to be selling into the bid. And if you're just looking at one price level like this, it's it's not right. You shouldn't just be looking at the volume that traded at 2058 or 20.58 and a quarter, what traded on the bid, at 152 against 430. What's important is comparing what traded when the market was bid at 20.58 against what was traded at 20.58 and a quarter, as the market is, like I said, it trades, bid against the offer. So, with that in mind, this red line is our low. It's an indicator you could get on NinjaTrader for free. My Orderflows trader software runs on NinjaTrader, and there's a lot of nice indicators that are free on there. So, one of the things I like to put on is this. You could have the lines for the high, the low, the open for the day. So, the high and low is important because oftentimes you're going to see the market react around those levels. So we came into this low down here and we're starting to move up. Okay, come back down. We rally from the low at 57 up to 61. It's a 4-point move. Come back down to 58. It's a little bit of retracement and then start moving up here. We're getting some ratios. You're starting to move higher. You've seen these blue numbers here: 30, 77, 37, 29. This is something that I like to call the 3 in a row. This indicated to me price is being rejected. The market is starting to go higher, and you tend to get them as the market's moving. You don't always get them. Some days you may not get this 3 in a row, but when you get 3 in a row, watch out. And again, just talking about the order flow a bit. The box in a bar, the box where you have the black around it, the square rectangle, is the point of control. It's the area where the most volume traded in that bar, the price level, and it often acts as support. If you think the market's moving higher, it's going to act as resistance if you think the market's going to be trending lower. So if you're convinced now that the market is going to start moving higher, look for it to be holding these points of controls, which it is. It held it here, came right down to it, held it here. So again, getting back to that Jack and the Beanstalk case, if someone came up to you and said, "Hey, I could show you how to predict support and resistance for the next bar based on what you're trading right now," a good starting point is that point of control. Where you have the most volume. I mean, it's not always going to work. Sometimes it bar number comes back down to it, or bars where you're going to have go green, red, green, red. I said for when a market's trending, it often acts as support or resistance. As we're coming down here, you can see it traded back up to it. Here, it traded just on the other side. And but for me, this is indicative of a move higher. And what happens is, the next chart, we did, we popped up another nice, another 2 or 3 points. Then we went sideways. Then all of a sudden, you're seeing, some ratios on the downside, indicating price is being rejected. As price starts to come back up here, the buying is drying up and the selling is taken over. That's what these numbers indicate, that there's lack of buying here, just as there was lack of selling on these green candles. On these red candles, it's indicating that there's lack of buying, that the market's going to be going higher. And again, this is, I hate to say a textbook example, because oftentimes there's no textbook examples. They just sort of, you get examples that look good or something. Ideally, in this case, I would much rather have a red candle here, just as on these 3 down candles, you get the green candle. I'd much rather get a pullback. Here you don't necessarily get the pullback. But what you're looking for are areas like this where price is being rejected consecutively on a move higher or a move lower. So this is just a continuation. So on the first one, just go back here. Yeah, this. It only gave you, a couple points, 2.5 up to almost, 4.5. That's not even 4.5. So, it's not the greatest trade. You probably could have got a point and a half out of it, maybe 2 points if you're lucky. But, it just went sideways here. If the trade is going sideways on you after you get in, it's usually not going to necessarily work out for you. I don't like to hold the trade for too long. But if it's not going anywhere, there's no harm in getting out. Just wait for your next trade. Save your bullets. You get a next trade that appeared shortly thereafter, this time on the downside. You get the 3 ratios, you got the green candle. This is your entry bar in here where it's telling you could be getting short somewhere in this candle. And this time it worked out much better. It went from 60 down to, 50, 55. So, it's a 5-point move. Earlier, I said if you got a point, maybe you get a point out of that move. But, this time, now you're looking, staring at a nice 5-point move. So, it's, there's examples like that are, that occur all day long. I'll say all day long, but they occur, during the trading day. You just have to be patient, and, when they appear, you got to take the trades. Okay, so, here's another example. This is, this red line here is the low, right? We came up off our low at 61. We got all the way up to 66 at that area. There's a 5-point move, and all of a sudden you get a selling imbalance, a stacked selling imbalance, 1, 2, 3, where there's aggressive selling coming in there, in the form of selling imbalances, where the ratio, what's traded on the bid against what was traded on the offer, is greater than 400%. Okay, in this next bar we opened down, we traded right back into it. Okay, so, what do you want to do? You want to be short on something like that, because it's telling you that, hey, there was some, the market moved up. All of a sudden, it's stopping up here, and you're seeing, sellers are coming in saying, hey, the price this is a good price. It's a nice high price. It's something that I should be looking to sell. It's if you, like going back to the milk example, if all of a sudden you realize, you can sell your milk now for $3.25 instead of $2.99. You want to start selling it as much as possible at $3.25. You don't want to necessarily still be selling it at $2.99. When you could sell it for 10% more. And so what happened? Okay, the market initially came off. Over the next few bars, hit a low level here. It came right back up. It came right back up to this area. It's acting as resistance. We were trading back into it. Can't get up, can't get through it. So you're seeing, you're seeing the sellers again, but the sellers that were there the first time in this stack selling imbalance, they're probably to a certain extent still in here looking to sell some more. And you got another ratio bounds low this time, which indicates there are sellers up here again. So there's different types of ratios. I might as well explain it a little bit. There's different types of ratios with the Orderflows trader. One will tell you, if there's lack of selling or lack of buying, indicating prices being rejected. In that sense, that the price isn't moving lower because there's not any more sellers to help move the price lower. Or what I call ratio bounds low, which indicates there's some good volume up in here. So I mean, if you're coming back up into a resistance area and that, again, you see a ratio bounds low, and it's telling you that there's some good volume, people have some supply to be selling up here, that's valuable information, especially, when you're looking back here and you see this level of resistance and you're coming back into it, again, you should already be short already, somewhere off in this area. But if you're not, it's giving you a second chance to be getting short. You're getting short from somewhere around the 65, 65 and a half level, and we trade right back down to the low at 61. So, it's, that's what, these ratios, that's why I have them. Again, you can go to my website and you'll find out a lot more about these ratios and how you can, apply it to your trading. Even if you don't, you say you have your own way of trading and you want to use order flow, that's what these ratios can help you with. Say you have your own way, you have your own levels that you like to choose every day. That's great. And, if you want, you can try to add the ratios to it, and, I think it'll help you become a more profitable trader. Okay, so, real quick, here's another chart. This is, again, it's an E-mini, it's a 5-minute chart. And, it's telling you a lot, right? It's telling you the market is starting to move up. You can see that. Here you have a couple bearish ratios, but you have a bullish ratio here. So, even if you're getting short off of this, it's telling you that, hey, the conditions in the markets are changing and the market's going higher. You're seeing some, buying imbalances in this bar. This next bar, you got a buying imbalance and you got a stack buying imbalance. Again, it's holding as a support level, and the market is, trading above it. So again, it's market generated information. When people say, well, for every buyer there has to be a seller. Yes, that's true. For a transaction to occur, there has to be a buyer, there has to be a seller. But not all buyers and sellers are created equal. Some are going to be aggressive. Some need to get into the market. Some need, some need to buy now. They need the either hedge their position. They need to, they think that everything's changing. They're trying to get into a position. They think the market's going to move. They're trying to position themselves for that move, so they're going to be aggressive. Oftentimes, a market just may trade back and forth, back and forth. That's what it's supposed to do, and that's what the market does most of the trading day. It just trades back and forth. But there's going to be those times where people get, so when people are being aggressive, I mean, that's the information. That's what you want to know. That's what you want to see in the market. You want to take advantage of it and, and join in on it. You don't want to fight. What would you rather do? Would you rather sell to an aggressive buyer, or would you rather, buy in the same direction that the aggressive buyers are buying? Because again, to see an imbalance, you're looking at a ratio of 4 to 1, which, 21 against 360, 211 against 1600. It's telling you that, there's, at least in the short term, there's, strong buying coming in to the market. I mean, when you see, one or two just sort of sparsed out, it's not as important. Yeah, it's important. It's interesting to see, but when you're seeing them grouped together, clustered together, that's important as well. And it's a sign that, hey, people are coming in, and the perception of the market is that it's going to go higher. That's why everyone wants to buy. Like it's going back to, are you trading the market, or are you trading people's perception of the market? Oftentimes I feel something. You're trading people's perception of the market. You're not necessarily trading value. Because what you're trading the mass psychology of what other people are thinking, and order flow will help show you that. So imagine you step back and you're just looking, at this chart, and you could be seeing, oh, okay, yeah, I see, people are being aggressive. On the buy side, like here, they started coming in, but they couldn't really string the numbers together. You got a selling imbalance here, one here, one here. Where's the rest of it? But you're starting to pull away. You sort of come down into this, call it this low, but you're starting to pull away from the low, but you're seeing people being aggressive, and the market's starting to trend higher. So I'll show you one more chart real quick here. Again, this is a 5-minute chart. I'm not a big fan of 5-minute charts, actually, of minute charts, but I'm showing you here. I showed range charts, I showed minute charts, because I know a lot of people use minute charts, and there's nothing wrong with minute charts. If you're comfortable with them, by all means use them. Me, I prefer range charts, just because I'm a big believer that I like to watch how price moves from level to level, as opposed to, well, it's 940, it's time to form a new bar, so I'm going to end it. That's not to say that you can't get good signals off of a minute chart. You can. But for me, my own trading, the way it's developed over the years, I've grown accustomed to range charts. But with that said, let's just look at this. Here you got a small print ratio of 37. That's indicating, hey, maybe the buying is sort of drying up. You can see it's a red candle, it's starting to trade a little bit lower. It came down into this single print here of 2 lots. Okay. It's a minute chart. You got a blue number, it's a ratio, and but what's happened? It's a very small bar. It couldn't. Is there more buying? You have this bullish signal here. It's telling you that the selling has dried up, and you get a buying imbalance right here, just off this low. why isn't the market going higher? You know, it should be going higher, but it's not. And then in the next bar, you're starting to see signs that the buying is dried up with the ratio here of 87 is telling you that buying has started to dry up, and look for selling. All of a sudden you see a lot of selling imbalances, 1, 2, 3, 4. Yeah, sure, they're spread out. I'd like to get them grouped together, but this up here is telling me that the buying interest has dried up, just as you saw here. The selling interest was starting to dry up, but you didn't get the follow through in the move. Now you're seeing it, sort of the opposite happening. You're seeing the buying interest, in this case, drying up, and now you're starting to see a lot of selling interest. You're seeing selling imbalance, selling imbalance, selling imbalance. This bar is screaming to you to be looking to get short. You could be getting short in this bar. Towards the end, it's a 5-minute chart. If after 4 minutes you're still trading down here, I'd be looking to get short. I mean, that's the good thing about minute charts. Sometimes I can get in, before the bar closes, just because, I know that it's going to form a new bar in 30 seconds or whatever. So, I'm fairly confident to take a trade before the bar closes. I generally don't do that on range bars. But, so, you're getting in at 61, and, it's a sign, you're seeing the signs up here. First you're seeing the failure of this ratio. I said, you should be looking for the market. It should be, it's a bullish sign, but why isn't the market going higher? Okay. So, if it's not going higher, if the market's not going higher when it should be going higher, what's it going to do? It should come off. It's either going to go sideways or come off. But if you're going to get a indication that that it's not going to go sideways, that it's going to come off, then by all means, jump on it. So you got a chance to get 3 points out of this, which is decent. 3 points, even if it's just trading a one lot, 3 points is decent money. So that's that's the benefit of order flow. You can look inside. If you're just looking at normal bar charts and you're seeing, you're not really analyzing the market. Yeah, you're looking at a chart. You say I'm analyzing the market, but are you really understanding the mechanics of what's happening, what's going on, or not? Most likely you're not. And if you're just trading with indicators, if you're trading with an indicator, some sort of indicator is telling you, hey, get long here. Well, you can look at the order flow and say, yeah, it's telling me to get long, but immediately after that, it's telling me, things have changed. The market's constantly changing. The market's trading. Different views are being espoused in the market. People are coming up and taking one view or taking another view, and that's what forms the market. Differences of opinion. So, I said, even though you get a sign here that is saying, hey, yeah, it could be the market should go higher, but if it doesn't go higher, and all of a sudden you see a sign that the market should start selling off, by all means, look to get short. So you're not married to this position just because, oh, I got a signal here that's bullish. I should be bullish, and damn the torpedoes, I'm going to hold the position. If you're getting bullish, but something comes in to change the the outlook of the market, why are you still looking to hold that position? You should be looking to get short. Get out or get short. Sit on the sidelines or get short. In the direction that the market's going to move. That's how you make money. You trade in the direction the market's moving. So, it's I think the benefit of order flow is allowing you to look at what's happening in the market as it's happening, rather than looking at something that happened earlier and trying to form your decision right now off of that. So thanks for sitting through this video webinar. And if you want to learn more about the order flows trader and the software that you've seen in this webinar, visit www.orderflows.com. I explain a lot. Order flows is it's not rocket science by any means. You know, it's taking the information that's available and putting it into a form that's easy to read, easy to follow, that, you know, will make trading, I won't say easier. I hate to use it. I hate to say easier, but, you know, it puts it in a format that's much easier to read and understand. You know, if you're watching, you know, time and sales, you know, or Dome, you see numbers just flashing through there, and, you know, if you don't know what you're looking at, you're gonna, you know, you get your head handed to you. Like I said, there's nothing wrong with trading off a Dome. You know, if you can do it, then great, more power to you. But not everybody, you know, can. Not everybody has the patience or the understanding to know what's happening, you know, as they're watching, you know, prices flash on time and sales. You know, order flow takes that information and puts it into a format that's easy to read, easy to understand, so you can see how, you know, how trade is happening in the market. You know, are people being aggressive? You know, is the market just trading sideways? Is prices being absorbed? Are we at a fair price? You know, that's really what the benefit of order flow is. So, you know, again, you know, visit my website, www.orderflows.com, and, you know, you'll see I've got a lot of other videos on YouTube. I've got a lot of examples on the website, and, you know, if you got any questions, shoot me an email. As I said, you know, it may take me a day or two to reply to it. I try to get through everything, you know, on a timely basis. You know, I'm one person. I'm not a big company, and, you know, I'm busy trading during the day as well. So, you know, I hope you're able to learn something in this webinar today. So, thanks again, and, you know, let me know if you have any questions. Thank you.